Okay, I want to welcome everyone to Forex Profits. My name is Angela Powerhouse Williams, and I am going to be teaching you guys a scalping strategy to be able to get into the Forex market and grab $50 to $100 a day. The strategy that I'm going to teach you, again, is something that you can use so that you can make money in Forex, but you can also use the same principles and the same strategies if you want to day trade, penny stocks, if you want to day trade the futures market, if you want to day trade Bitcoins. It is a universal strategy. I've used it across all asset classes, and I know for a fact that it works. So this week, which is session 1, I'm just going to be introducing you to the world of Forex. Disclaimer, I am not a financial advisor. I will not tell you what to invest in nor pick stocks or trades for you. This training is for educational purposes only. Please be aware that all trading transactions can result in potential loss, and you should only be trading with disposable income. So what does that mean? Don't be trading your rent money thinking you're going to flip money. That's not what we're doing. You should not be trading with more than you can afford to lose. Disclosure. You may not discuss, share, reproduce, copy, reprint, modify, rewrite, create, distribute, publicly display on social media, publicly perform, license, or sell content that you retrieved or learned from this presentation without the express prior written permission of myself, Angela Williams, owner of Financial GPS 360 LLC. In order to get access to the Forex class, it is by invitation only. If you joined my econ, and you are on my team or any of my team members' team, then obviously you got access to this class with your membership. Other people pay for this course. And if you know anyone who may be interested, reach out to me because it also pays out a referral commission as well. Now, before I get started talking about any trading, I always go over the 4 ways that you need to be mastering your money. And I love to use Robert Kiyosaki's Rich Dad, Poor Dad, his cash flow quadrants, because it's dead on where you should be and where your money should be coming from. But also these 4 quadrants represent the tax laws all at the same time. And so everybody that is on this webinar at some point in time, you may have started as an E quadrant. And an E quadrant just means that you are an employee. You are basically trading your time for money. You go to work, they pay you. If they decided to lay you off, then the income stops, right? Well, here's the problem with staying as an employee. Employees are taxed at the highest tax rate in America, up to 37%. So in order for you to make more money, and so if you want to make more money, and you want to keep Uncle Sam out of your pocket, then you're going to have to advance to the other quadrants, okay? Also, in about 40 years, not 40 years, in 15 years, 40% of all jobs in America will be replaced with AI technology. And so for those people on the My Econ side, you already know, I already told y'all that technology and AI is taking over. We already been preparing ourselves. If you're not in My Econ, I suggest you do the same. There is nothing that you do right now at your job that cannot be replaced by a robot or technology, okay? So you're gonna have to learn how to create your own income. You create it on demand. Now, what you wanna do as an employee is you wanna advance up the quadrant. So the next quadrant is the S quadrant. And the S quadrant means self-employed. That means that you become a business owner. So it's either you launching your own dream business, maybe you are part of My Econ, in which we have a home-based business. It all qualifies as self-employed, because as a self-employed individual, you can also earn a 1099. Well, when you're self-employed, that means that you have access to additional streams of income. So not only are people making money from jobs, but they're also making money from the My Econ opportunity. They also get the tax advantages. So again, when you're self-employed, there's things that you pay for every month that you're going to be able to write off. So that's your cell phone, that's your internet access. You buy a computer, you get to write it off. I know a lot of you who are trading are investing in new computers. Guess what? If you are a business owner, that is a tax write-off. the food that you're eating out or buying at restaurants and picking up. Once the world opens up and people go back to traveling, we're able to write off our airfare and our hotels. We reverse for the miles that we drive on our car. So it's a huge benefit in being a business owner. And those tax advantages shield our income. So if you're in this Forex class and you're not in a business opportunity, what I'm going to tell you is that the government is going to take a whole lot of the profits that you're going to get out of the Forex markets. And so be smart about it. Get you a business, join MyEcon, do whatever you need to do so that you ain't sitting up here spending all your time learning how to trade and you making money. And at the end of the year, when the brokerage company sends you a statement that said you made an extra $20,000 in Forex and you have made $60,000 at your job, you mad because now you taxed at $80,000 because you only have a job. Where when you have a home-based business, we are able to keep our $20,000 and not pay taxes on it. So that is where you want to be. Now, you don't want to stay at the self-employed quadrant. What you want to do is you want to advance and you want to get into the B quadrant. Now, the B quadrant, we call that big business, but what that really means is there are certain people who are able to have the power of leverage working for them. And leverage basically means that you either making money off of other people's money or you making money off of other people's time. So if you're working a job, your boss is making money off of your time. Even though they're paying you, they're not paying you all they can pay you. They're not paying you exactly what you're worth. They're just paying you enough to get what they want to get done, right? So if you invest and you become a real estate, let's say you buying real estate, you buying investment properties, you got an apartment complex and you got people living in your apartments. Well, guess what? That asset of you buying that building is now bringing money from you because you're getting monthly rental income. Well, what is that? That is residual income. Now, the other way to make money is off of other people's money. That's why people fix their credit so that you can get trade lines and use other people's money so that you can buy assets and flip the assets, right? But then you can also make money off of other people's time, just like employers. So in MyEcon, we can share the opportunity and we can launch other business owners. And when those business owners make money, we make money as well. So we earn residual income every single month. So as a CEO Infinity at MyEcon, over 1,000 people in the organization, $8 a month, that's $8,000 every single month for work that I did 2-3 years ago. And so I'm able to have leverage in my MyEcon business without putting up no real money. And that's where everybody wants to be. Because if you're not making money in your sleep, you're going to work till you die. And so what we want you to do is get all the money. You get the money from your job, you get money from a business, you get money from building a team, you get money and you take it. And what we want you to do is go to quadrant I. That's the fourth quadrant. Quadrant I is for people who are investors. These are the people who money is having babies. These are the people who own real estate. These are the people who own stocks. These are the people who are day trading in Forex and futures, okay? And what we do is we able to turn $1 into $1,000. And that's what you want, because as an investor, we're only taxed at a 15 to 20% tax rate versus somebody who's an employee where you can get taxed up to 37%. And so it's not about how much money you make, it's about how much money you can keep, but how much of that money goes to work for you. As long as you stay on the left side of the quadrant as an employee or just having a business that you're not really building, you still rent your lifestyle because all of your income is still dependent on what you do. Now, if you get on the right side of money, where you build leverage and you making money in your sleep, you getting them residual income checks, and then you investing and you flipping money, now you own your life. So 90% of the people in America work for the top 10%. And 90% of the wealth in America is owned by the top 10%. And so what we're trying to do, especially those who are in MyEcon and on my team, we're trying to get people to progress throughout the quadrants and master the quadrants and get out of debt and get all your money and take your money and flip your money. That's what we want you to do. Now, the whole goal of me teaching you how to trade in the Forex economy is, number one, I want you to mind your money. I want you to worry about your economy. And so what you got to understand, especially with the recession that we're already in, and then we have so much uncertainty in regards to this virus, you have no idea what America is going to look like by the end of this year or at the beginning of next year. And if we don't get this virus under control, or if there be a second wave of virus, there are going to be more people who are going to be losing their jobs. And I'm not talking about just worrying about a recession. We're going to go into a depression. It is going to be on a level that you have not seen before. And as it hits the job market, it's also going to hit the real estate market. And what's going to happen in America is it's going to be the survival of the fittest. And so you're going to have to figure out how to create income insurance. And the only way to do that is to learn how to day trade. Now, you're going to be able to make money from the comfort of your home. It's going to take you 1 hour to 2 hours daily to commit to learning this skill set. You are going to have to look at the charts. You are going to have to pay attention to the markets. You are going to have to look at financial news stations. You can't make a whole lot of money and not put no effort into it. It don't work that way. But this is a skill set that is going to save your life. And it's also a skill set that you're going to be able to teach your kids so that you can break the strongholds of debt. And so this is the answer to addressing poverty. Because the great thing about Forex is it doesn't cost a lot of money to get started. You can open up an account, I say $150, but you can get started in Forex with an account for as little as $50. So that means that anybody can play. But the key is to have discipline and consistency. Learn the strategy that I'm going to teach you next week. And once you do that, you're going to be able to turn a $50, $150 account into a $1,000 account, into a $5,000 account, to a $10,000 account, to a $50,000 account. And so the strategy that I'm going to teach you is going to allow you to wake up in the morning, pull up your laptop, pull up your phone, or pull up your iPad, literally jump in the financial markets and grab out $50 to $100. And that's just on a low day. That's an extra $1,200 to $2,400 cash in addition to your job. And then as you increase your skill set, we talking $3,000 a month, $5,000 a month, $10,000 a month, $50,000 a month. It can happen. It takes time. It's not going to happen overnight. But for those people who are serious, this can definitely work for you. All you're going to need is you're going to need a phone. You're going to need a computer. I know a lot of people may want to trade just from their phones alone. I'm here to tell you, you're not going to see a big picture if you're not trading from a computer. Now, I prefer HP computers because the system that we're going to be using to trade the Forex market is MetaTrader 4, and MetaTrader 4 is a Windows platform. And so it's going to work very good with HP. So for you Mac people that is out there, I do suggest that you invest in yourself. Take about $200, go to Walmart and buy you a HP laptop. Because we've been trying to figure out workarounds and patches and softwares that you can download to your Mac to make your MetaTrader 4 work. And for some people it's working, and for some people it ain't. So to keep it simple, invest in you, buy your laptop, okay? You're gonna need good internet access. And then you're gonna need my trade plan that you're gonna get next week. Now, the difference between stocks and Forex, because sometimes I hear people talk about day trading, but they're kind of two different things. What we're doing is we're speculating. And speculating is basically mean that we think the price is going to go up, or we think the price is going to go down. And what we want to do is we want to jump in position and to be able to take advantage of it, okay? When it comes to a stock, you have to buy the stock and own the stock. Now, people buy stock because they think the price is going to rise over time. And then once the stock price starts to rise, you want to sell when you think that the stock price is probably about to go down. So you want to sell and you want to ring the cash register and you want to take your profit. So when it comes to stocks, especially for people who may be trading penny stocks like myself, we're buying the stock, own the stock, and then we flipping the stock. Now, some people buy stock, own stock, and hold stock, and that's for long term. There are people that are holding their stocks for a year, 2 years, 3 years, 4 years, 20 years. Those people are normally holding stock for retirement purposes. Now, for day trading, we're pretty much flipping stock on a daily basis. Now, obviously, there are options that are out there called option contracts that people can use to be able to flip more expensive stocks. But again, the concept is still the same. With a stock, you're buying to hold, you're waiting for the price to go up, and then you sell. Now, the problem with that is you can't make money on a stock when the price go down unless you are investing in options, okay? So how can we make money when the markets go down? Well, one way to do it is the Forex market. And the great thing about Forex is it's not a buy to own. What we're doing is we're taking a position in a currency at a certain price. And if we believe that the price of that currency is going to go up, we can do a buy, or another term is we're going to go long in that position. So let's say it's a currency and the currency $3. Let's say a currency was $3. And I believe that the economy is booming in that country, and I believe that that currency is going to go up. And so I want to get in position with that currency, let's say at $3, okay? So I want to get in at that currency at $3. Please mute your background. If you unmuted your background, please mute it. Thank you. So if I want to get in at $3 and I thought that the price was going to go up to $7, then I could go long. So I could take a buy position at $3. And if it goes to $5 or it goes to $7, I get to make money. Okay? So that's what going long means. You think the price is going to go up. Now, you have the option to also make money when the markets go down. So if I am looking at a currency, and let's say the currency is $5, and I think that some doom and gloom is coming to a country, or the Fed is about to do something that is going to affect the currency, I can say, you know what? I want to buy this currency at $5, but I think the price going to go down. So I can take a short position, and I can hit the sell button and take a short position, get in at $5, and if the stock goes down to $1, I made money for the difference between $5 and $1. See, that's the beauty of being able to day trade. When you able to day trade, you can make money when the price goes up, and you can make money when the price go down. People who are just buying stocks, they can only make money when the stock price goes up. That's why when the markets crash, you see everybody hooping and hollering about, oh, my 401k in the red, I'm so down. That's because they don't know how to day trade. They only know how to invest in stocks. Where we are over here smiling because even when the market go down, we can take a position and we can short the market and we can make money when everybody losing. So what is Forex? Forex is short for foreign exchange. And basically this market, again, is used for investors and speculators. What we are speculators. Forex is one of the largest liquid financial markets in the world. Over $6 trillion hit the Forex market every single day. So even though $6 trillion hits the Forex market every day, as a retail trader, which is what we are, we only have access to $1.9 trillion every single day. So we don't have access to the whole $6 trillion industry. The rest is going to be for banks and big investment firms. But as a retailer investor, 1.9 trillion is out there every day that we can go in and we can grab some of that money, okay? And as you can see, the Forex market is more liquid than the futures market, which 437 billion hits the futures market every day. 191 billion hits various equities every day. And then we got the New York Stock Exchange, where 28 billion hits it every day. Now, for some people, out there, I hear them say, oh, we're going to do Forex because it's the largest market. Well, if you are on my team in my econ, you already know that that ain't what we doing. We doing everything. We doing everything. So when you in my econ and you on my team, you're going to learn Forex, you're going to learn futures, and you're going to learn stocks from a trade perspective and a long-term investment. We want all the money on the table. And you can't be a master trader if you're only trading one asset class. If you're a master trader, you can trade all asset classes. And that's what I want you all to have. So obviously we can't go over everything, so we take one chunk at a time. And in this class, we're going to talk about Forex, right? So $220 billion an hour hits the Forex market. And when you think of currencies, the easiest way for me to describe it is, let's say you're from the United States and you're going to Cancun, you're going to Mexico, and you're going for vacation, all right? And what you want to do is you're going to go over there with US dollars. When you get over there, you're going to have to convert your US dollars into Mexican pesos so that you can buy foods and gifts and products, whatever you want to spend money on. Okay, so there's a conversion rate. And so, for example, $1 US is equivalent to $18.80 in pesos. Okay, so a country's currency rate is based on pure supply and demand. Okay, and what this means is that the US dollar is stronger than Mexican pesos. That means that the US dollar can buy you more in Mexico. And since the US dollar is stronger, that means that the US dollar is appreciated. Because the US dollar is stronger than Mexican pesos, that means that pesos is depreciated versus the US dollar. Again, a dollar in the United States will buy you $18 worth of products in Mexico. So your money go a long way. But it's not always like that. The US dollar is not always the highest appreciated currency. There are other currencies out there that are valued higher than the US dollar. So where the US dollar could be depreciated with, let's say, the Swiss franc. All right, so you always want to know what the exchange rate is for currencies, okay? But this is just an example of what it is. And so when you take a dollar and you convert it into pesos, there's also a spread fee between the two. That is how the currency exchange make money. That's how the banks make money. And what we're going to do is we're able to make money in the price fluctuations of different country currencies. Now, who are the major players in the Forex market? Well, normally it was big money, okay? Governments, you know, every government in a country has a currency. The central banks, big businesses, because United States is an international company. So we got products that are being bought and sold internationally. Okay, so currencies are always being swiped out. There's also institutional investors are in the Forex market. The big ones are banks. Okay, the big ones are banks like the Citibank, the JP Morgans, the Bank of America, and wealthy people. Because a lot of times there are companies in the United States, or there's wealthy investors in the United States that actually want to invest overseas. You know, so there's a lot of investors in America who are investing in Africa. Okay, well, guess what? The dollar is worth more than the currency over there. So your dollar can do more for you. And so you can go over there and you can buy a house that will be the equivalent of a mansion versus a single family home here in the US if you did it in Africa. Okay, and so you can invest in other countries because of that difference in buying power. You can also buy different bonds. There's international bonds that you can invest in to where your US dollars can make more money by investing internationally. Now, for the past, I want to say 5 years, the Forex market has been open to retail traders. Like I said, it was always banks. It was always countries. It was always wealthy people that had access to Forex. But as retail traders, because of the internet, because of technology advancements, now us little people can get access to the same market that billionaires and that billionaires have access to. So that's powerful. Now, banks make money off of you. Now, everybody should know this, especially if you in my econ. In my econ, we already teach you don't keep your money in the bank, because the bank makes money off of your money. So whenever you deposit, if you go deposit $10,000 and you put it in your savings account because you want to use your bank to store your money, right? And what do banks tell you? Your money is safe. Your money is backed by insurance. Put your money here. And just by putting your money here, we're going to pay you in that savings account. And we're going to pay you a whopping 1%. And in most cases, it's less than 1%. But your money is safe. And you're like, oh, my money is safe, so I'm going to keep it in the bank. And I'm making 1% interest. Ain't that cool? No, it ain't cool. Because guess what? They're going to take your $10,000. As soon as you put that money in your savings account, that money is gone. It's no longer there. On paper, it's there, but that money is gone. And what they're going to do is they're going to take that money and they're going to trade that money in the Forex exchange and make more money off of your money. Then they're going to take some of that money and they're going to loan that money to somebody. And let's say that person doesn't have a great credit score and they can charge that person higher interest rates. They're going to make some more money off your money. So whether or not you know it, the banks make 1,000% return off of every dollar that you leave in the bank. And so that is why we don't let the bank make money off of us. We're going to make money off of us, so we don't keep our money in the bank. Let's talk about when you can make money in Forex. Now, the Forex market is literally available 23 hours a day. It is available 6 days a week. So you can trade the Forex market from Sunday at 5 p.m. Eastern to Friday, 5 p.m. Eastern, okay, which is really 4 p.m. Central, okay? And so from Sunday to Friday, you can trade the Forex markets. The markets are open 23 hours. They pretty much shut down for like 45 minutes to an hour. In between like the New York session closing and then the after hours opening, but you still got 23 hours. Now, what I want you to see is that every country or every bank, I want to say, is trading Forex at different times, okay? So if we look at this chart here, if we start off in the morning, so on the right-hand side is the morning, okay? So at 4 a.m., and this is all Eastern Standard Time. So 4 a.m. Eastern is 3 a.m. Central. So at 4 a.m. Eastern, the London session opens, okay? And then if you notice, at 9 p.m. Eastern, which is also 8 a.m. Central, the New York Stock Exchange opens. Okay, what you'll notice is that there is an increase in volume whenever a market is kind of layering over each other. So the London and the New York Stock Exchange is open at the exact same time at around 9 o'clock. So that's why when the New York Stock Exchange opened, pretty much about 8:30 Central, it is a lot of volume. That's when all the money starts dumping into the system. Okay, and as you can see, to about 12 o'clock, London session closes. And so if you really pay attention to when the markets move and you start paying attention to these time frames, you will see how the markets go up and down as one session open and another session closes. Okay, and so the New York Stock Exchange in the afternoon closes at 5 p.m. Eastern, which is 4 p.m. Central. Now, for retail traders, the markets actually close at 3 p.m. Central. There is an after-hour run for people who are qualified to run in the aftermarket sessions. So that's why it say 5 p.m. Eastern or 4 p.m. Central. All right. Now, as the New York session ends, the Sydney market opens. And again, it's more of a slower paced market. But at 8 p.m., the Sydney and the Tokyo session are layered together. And so you may see a spike in the markets moving, especially for those that are trading indices, and you'll know about that in just a second. You will see how the markets move at those time frames. So I just want you to pay attention to that, and just keep that in mind. But what I tell people is that there are really two times where the most money is actually in the markets, where it's like guaranteed pretty much money. That I call it guaranteed money, right? And that is from 8 a.m. to 10 a.m. Central. You are going to find money in the system, because that's when the New York Stock Exchange open up and the London session is there as well. Okay, so the next time slot is 2 a.m. to 5 a.m. Eastern. So that is 1 a.m. to 4 a.m. Central. Why? Why? Why is that important? We got the London session. We're trading the London session. And as you know, there's an overlay between the London and the Tokyo session. So you'll always see a move on your charts in these two time frames. So you should be able to make money between 8 a.m., 10 a.m., and 2 a.m., 5 a.m. Now, that's not saying that you can't make money throughout the other sessions. I'm saying the most money. I only trade when the most money is in the market. Now, when it comes to currencies, there are a lot of different currencies that are out there, but there are 8 major currencies that every major trader trades. And basically, 85% of all currency trades includes the US dollar. So there's the USD, which is the US dollar. There is the euro, which represents Europe. So 39% of all currency trades include Europe. Okay, again, everybody trades the US dollar. Then there is the British pound for Great Britain. 13% is represented there. 6% of people trade the Swiss franc. Okay, that's what CHF represents. It represents the Swiss franc. Then we have Australia dollar, AUD. We call that the Aussie. We call that the Aussie, yes. All right, and then we have the Canadian dollar. So then we have the Canadian dollar, and then we have the New Zealand dollar, and then we have the Japanese yen. And so 19% of people trade the Japanese yen. So like I said, every country has a currency, all right? And when you're looking at these, the last digit pretty much represents the denomination, okay? So as you can see, USD, dollar. AUD, the Australian, dollar is the denomination. The Canadian, they're using the dollar. New Zealand, they're using the dollar denomination, okay? Obviously, the euro is the euro. The CHF, the F represents a franc. It's the Swiss franc, okay? Japanese, they got the Y at the end. That represents yen. I do believe that people are trading with the, on a Chromebook. I do believe that people are trading with the Chromebook. Yeah. So again, when it comes to the currencies, each country has a currency, but in order to trade, you are trading a currency pair. And that is where two different country currencies are basically being traded together. They're being pitted one against the other. And so obviously, There are a number of different currency pairs that are out there, tons of things that you can trade. But what I want to focus on, what I'm going to be focusing on with you is the top 7 major currency pairs, the top 7. And that is the Euro USD, the United Kingdom, which is the Great Britain pound versus the US dollar, USD JPY, which is United States versus Japan, USD versus the CHF, which is basically the United States versus Switzerland, Swiss franc. We got the USD versus what? Canada. We got the AUD, which is Australia. We call it the Aussie versus the United States. And then we have New Zealand versus the United States. So these are the top 7 currency pairs. So you don't have to trade everything under the sun. You can trade all 7, or you can pick 1, 2, or 3 out the 7. Okay, it doesn't matter. You could trade just one. For a long time, I just traded EUR USD and made good money doing it. But then I also like to trade the USD JPY. So you eventually, as you start to look at the charts for these currencies, you're going to decide where you want to spend some of your time. But there's money to be made in every currency. Again, 72% of all currency pairs that are traded are these top 7. Then we have what we call minors, and these are other markets where people maybe are trading the euro versus Great Britain, okay, euro versus Switzerland, euro versus Japan, okay? And then we have some exotics, okay? We got USD, ZAR, that's USD versus Africa, you know, so there's different exotics that are out there, but like I said, just for learning purposes, keep it simple. Just keep it simple. And as you build your knowledge base, you can always incorporate more strategies. But even though I'm talking about currency pairs, you guys, toward the end, I'm going to talk more about where I want you to put all your focus on, and it ain't currency pairs, right? I just want you to know what Forex is. So let's break down currency pairs and what it means, okay? Remember, every currency is pitting one country currency against the other, so they're always a pair. The first currency that is listed in the pair, so right here, this is a currency, EUR versus USD. EUR is considered the base currency. That means if you are taking a trade on this currency pair, you are making your decision based on the euro. That's what you're doing it. It's based on the euro. The USD is the quote of the currency. So basically, this USD is going to represent the amount that you need to buy or sell the euro. But whether or not you decide to buy a currency or sell a currency is going to be based on the base currency. So if you decide, if you think, let's say you think the euro is going to go up. So you want to buy the euro USD currency because you think the euro is going to go up. It's going to have more power than the US dollar. That means that when I buy the euro, I'm also going to be selling the USD at the exact same time. But I'm buying because of looking at the information on the euro, not the US dollar, the euro. So when you are buying currencies, we're using MetaTrader 4, and this is pretty much what the panel looks like in order for you to buy and sell a currency. And so what I want to do is I kind of just want to go through the buy and the sell, and basically what that functionality means. And so if we want to trade the EUR USD in MetaTrader, the platform is going to have EUR USD. It's also going to tell us the time frame that we're going to be taking our trade off of. There is a sell button and there is a buy button. So if you think that the euro is going to go down and you want to get in position and you want to ride it down, you're going to hit the sell button. If you think the euro is going to go up, you are going to hit the buy button. Okay? So again, whenever you hit sell or buy, it is based on the base currency, and that is the first currency listed in the pair. So let's talk about this sell button. This sell button is also known as the bid price. The bid price is always lower than the buy price, which is also known as the ask price. Well, why is this important? There are always two people at the end of a transaction. So if I'm buying, somebody's selling. If I'm selling, somebody is buying. Okay? So that means that when I'm selling, somebody is willing to sell me the currency at that price. And when I want to buy, I'm finding somebody who allow me to buy the currency at a particular price. So it's always two people at the end of a transaction. Okay? Now, these numbers right here, the first number in front of the decimal point is pretty much the dollar. It's, well, $1. It's represent 1 unit, $1. Okay, so this will represent 1 euro. The pip, which is also known as the price interest point. Okay, it is a measurement of movement in whole digits, and it's usually the digit after the 4 digits after the decimal. So we got a 1, we got a decimal, and then we got 1, 2, 3, 4. This last digit, which is the 4th digit after the decimal, represents a whole pip. So look at sell and look at buy. This 4th digit is a 5. This 4th digit is a 6. So there's a 1 pip difference between the sell and the buy. Okay, so anytime somebody said I caught 3 pips. So if a person caught 3 pips, and let's say they hit sell, and they hit sell at this price, if they caught 3 pips, that means that when they closed the trade, it was at 2. It was at 52. So 50 to 55 from 52 is 3. So that's 3 pips. So your pips is always the last digit after the 4 digits. Now, for some currencies, that is not the case, but for majority of the currencies, your pip is the 4th digit after the decimal. Now, for the Japanese yen, it's only 4, and it's only 2 digits after, there's 2 digits after the decimal. So it's the last digit in the decimal, okay? But for most of what you're gonna be trading, like the EUR USD, your pip is gonna be the 4th digit after the decimal. The small little digit in the upper right-hand corner represents pipettes. And it's just a fraction of the pip value. So basically, let's say a pip is at 5. As it starts to go up, there's little pipette values all the way up into the next whole digit. Okay, so we got the pips. This is the pipette. Now, the difference between the price on the sale and the price on the buy is considered the spread. Okay, and so in this example, the sale is a 5, the buy is a 6, so the difference is 1 pip. And then if you look at the pipette, there's a 7 and there's a 3. So that makes the spread 1.4. Now, the best way to describe the spread is the fee. It's broker fees, it's also the bank fees of doing this exchange. So remember, the bank's got to make money. Somebody got to make money in this transaction. And so the money is made with the spread. And so what you have to do is when you take a trade, you are immediately have to make up the spread before you even get into profit. So basically, the banks want their money up front. They want their money up front. And so at the end of this presentation, I'm going to show you what we're going to trade that allow us to really get into money much faster with lower spreads, okay? And so this is what it is. If you think the price going to go up, hit buy. You think the price going to go down, you hit sell. To know how many pips you got, you look at the last digit, which is the fourth digit after the decimal, okay? That's your pips. The next thing that you want to pay attention to is lot size, okay? And lot size is basically going to tell you how much money you're going to make per pip. Now, for some brokers, they will let you set your lot size so that no matter what you trade, you're always trading the same lot size. If you don't set that in your system, you also have to be mindful to make sure that your lot size is where you want it to be based on your risk level. Okay, so for example, and we're talking about EUR USD. And let's say you set your lot size not from 1.00, but you change it and make it 0.01. So 0.01 means that you're going to make 10 cents for every whole pip. So if it goes from 5 to 6, you made 10 cents. If your lot size is 0.10, then you're going to make $1 per pip. If your lot size is 1.00, then you're going to make $10 per pip. 10.00, you're going to make $100 for one whole pip move. So if it goes from 5 to 6, you made $100. If you do 100.00, you can make $1,000 per pip. Now, this is true for most currencies, but we also trade the indices. And with the indices, the money is going to be a little bit different. So when you're trading an indice, a 0.01 is pretty much equivalent to almost like $1. And your 0.10 is kind of equivalent to probably about $5 a pip. It depends on what asset that you are trading, but this is just the standard. Now, when you are trading, you're able to decide how much leverage you want to be able to do in your account. We are going to be doing the 1 to 500 leverage, and the broker that we're using is allowing us to do 1 to 500. Now, there are other brokers that only allow you to do 1 to 200 leverage, but we get to do 100 to 500 leverage. What does that mean? For example, if you put $1,000 in your Forex account with the 1 to 500 leverage, you'll be able to trade 500,000 of currencies for $1,000. You see how much leverage that is? It's amazing. And so the lot size that you start with, my best advice to you is based on how much money you put into your account. If you put $150 to $250 in your account, I will encourage you to stay at the 0.01 lot size. I want you to start small. See, it's not about winning a lot of money. It's about being consistent in your wins. Your account will grow over time. As you grow your account, once you have $500 to $1,000 in your account, then I would recommend that you trade lot sizes of 0.10 to 0.50. If you open your account with more than 1,000, but let's say less than 5,000, then you can set your lot size from 1.00 to 5.00. If you got 10,000 in there, then you can set your lot size at $10. That means you'll make $100 for every one pip. And obviously, the more money you have in your account, whether you got 50,000 or something like that, $100 lot size. That means you're gonna make $1,000 per pip. Now, don't be that person that got greed in their mind to where you open up a $150 account, but you using $1 lot size. Because even though you can win and you can make some quick money fast, just how you win, you also can lose. And that will be the fastest way for you to blow your trade account, is by trading too high of a lot size. So I would prefer that you start low, build your account up, build your discipline up, build your win consistency up, and then increase your lot sizes for more money. So let me give you an example. Okay, so if we look at this chart right here, and to keep it really simple, each one of these candles have money in it, okay? And it represents a point of time. So let's say, for example, I think this is a 5-minute chart. So if this was a 5-minute chart, it means that every candle represented 5 minutes of time. All right, and we're going to be going into candlesticks and what they mean in a later session. But to keep it simple, when you see a red candle, that means that the price is going down. The price is going down. When you see consecutive back-to-back red candles, the prices is moving down. When you see a green candle, that means that the price is moving up. And so what you want to do, just keeping it basic, if a candle is starting to form red, you want to get in a candle at the top and ride it down. If you think the price is going to go up and a candle starts to form green, you want to get in the candle at the bottom and ride the candle on up. That's as basic as it can get. Red is sell, green is buy. All right. Now, I don't want you trading just on that basics. I'm going to actually give you a trade strategy next week, so you'll know when to get into the market, so that you can have a higher probability of winning and getting money. But what I want to show you is, let's say, for example, the market opened right here. The market moved down, okay? And then the market started to move back up. That's pretty much what it did. It started to move up. Then I see a green candle. I see a second green candle. I see a third green candle. So that's pretty safe to say that the market is moving up, but it might move up higher. And let's say I want to get in position. I want to ride this up. I think it's going to be a breakout to the upside. I can actually hit the buy button. I can hit this buy button, and it is going to put me in this candle at the price of 1.1156, because that was the current buy price, right? So I got into this candle at this price. Now keep in mind, when you take a position, you got to make up the spread. So the difference between buy and sell, you got to make that up first, and then you're in the money. So if I get into the candle right here, the spread line will be up here. So basically there's like a 1.4, there's a 1 pip difference, pretty much a 1 pip difference between buy and sell. So when I get into this candle at this price, it has to go up at least 1 pip for me to even get in the money, to get in the position to make money. So you got to cover the spread first. So if I buy right here, I'll buy at 1.156. I'm waiting for it to move up a pip. It did. And as soon as it crossed this line, any move higher is my money. So as you can see, this candle moved higher. This candle closed. Another candle opened, and it moved higher, and it moved higher, and it moved higher. Then it started to pause, and then it started to fall down. Now, at that time, I can close out my position. And when I close out my position, I made money from this point to this point, okay? And so if you understand that, you'll understand how to take a trade. But I'm going to give you a strategy next week so that you can be a high probability that you can catch a breakout like this. Okay? Because what I don't want you to do is I don't want you buying and just selling random individual candles. I don't want you to do that. That's gambling. You're going to lose more than you win. Once you follow my strategy where you'll be able to identify when a breakout to the upside or the downside is about to happen, you'll win more and you'll win more money, regardless of the lot size that you're picking. Okay? So keep in mind, I thought the price was going to go up. I wanted to get into position of a green candle. Once I got into position, I needed to make sure that the price crosses the spread, cover the spread, and then I'm in the money. And then I decide when I'm going to ring the cash register and take my money. Okay, so this is an example of profiting by going long. So going long means you are buying because you think the price is going to go up. Now, what if the markets are crashing? You know, the unemployment rate is super high and the markets are about to fall, right? I want to make money on that fall. So let's say I'm looking at the markets open here, price went down, it went up, it moved sideways, then it was this big old move up, market moved sideways, it went down a little bit, and then it went up some more, right? But maybe something happened in the news, and I believe that this is as high as it's going to go, and it's going to fall back. It's going to fall down. And so here's what I can do. I can say, you know what? I think the markets are going to go down. I want to take a short position. So I'm going to jump in a red candle because I think it's going to short down. And let's say I jump in this candle right here at the price of, let's say 1.1155. Let's say that was the price, right? Now, I have to cover the spread first, right? So let's say this is 0.55 and the difference between that and the buy price is 1 pip. So that means when I jump in right here, I got to make up at least a pip to cover the spread. And as long as the price continues to fall down past that point, I'm in the money. And so I'm in the money, the price go down, this candle closed, this candle opens, price go down some more, this candle closed, this candle open, price go down some more, okay? And let's say that I decide to ring the register. I want to take my profit. And let's say that the price closed at 1.1144, okay? So 55.44, I caught 10 pips. I caught 10 pips on this move to the downside. So if I caught 10 pips, how much money would I have made? Well, if your lot size was 0.10, which is one of the lowest, it's not the lowest. I think you might go lower than that, but let's say 0.1, you made $1. You made $1 off of catching 10 pips. Now, for some people, they're like, man, I need to make more money than that. But what I'm telling you is when you're first starting off, you're starting off small. Once you get your confidence up, then you increase your lot sizes, okay? So that's $1. But what if I was trading 1.00? Then 10 pips is $10. But there's other asset classes that pay out even more. But let's say here, I'm trading $5 lot size. Then 10 pips is $50. So depending on the asset class that you're trading will determine the value of your pips. And so we trade the indices, and with the indices, we can actually make even more money, okay? But I just wanted you to see what it looks like when you buy the markets and what it looks like when you sell the markets. Now, there's 4 types of Forex traders. The first type of trader is what I call a scalper, and that's me. And the trade strategy that I'm teaching you is basically teaching you how to scalp. Even though you can pick up more than 5 to 10 pips, but the initial move is a scalping move. And a scalper is somebody who trying to get in and out of the markets fast. You trying to grab 5 to 10 pips every time you trade. You in the market a couple of seconds. You in the market a couple of minutes. Most of my trades is in less than 5 minutes. It's in less than 5 minutes. You can make $50, you can make $150, you can make $400, and you can make it in less than 5 minutes with the strategy that I teach. The second type of Forex trader is what we call day traders. And day traders are people who trying to get anywhere from 20 to 40 pips. Now, day traders, they're trading within a day. The scalpers, we're intraday, we in and out, okay? And so a day trader, you're trading within a day. A day trader usually trades off a 4-hour, 1 hour, or a 15-minute chart because they're holding their position a little bit longer to catch more pips. Scalpers, we are basically trading off of a 5-minute chart. We in and out 5 minutes, y'all. Then we have what we call a swing trader. And a swing trader is somebody who's trying to catch a whole bunch of pips. And they can hold their position open for a day, 2 days, 3 days, up to a week. This is more experienced traders. They trade off of the 4-hour and the 1-hour chart, okay? But again, this is for more experienced, skilled traders, it's swing traders. The fourth type of trader is what we call a position trader. And a position trader is somebody who's trying to catch 500 to 1,000 pips in one trade. Not they catching 100 pips in a couple of trades or 1,000 pips in more than one trade. This is somebody that getting 500 to 1,000 pips in one trade. This is somebody who's usually trading off of pivot points. All right. Again, these are traders who are big money earners, hedge fund managers, George Soros, who made $1 billion trading Forex. You guys, these are people who are catching 1,000 pips for every trade. They're trading off of daily charts. They are trading off of daily charts. So that's just a whole nother level. And like I said, it is for more advanced traders. The strategy that I'm teaching you will fall between scalping and day trading. Now, because of the validity in the markets and the way different things are happening, because y'all know the markets will go up and then they drop 100 points, 300 points. You can actually catch 50 to 150 pips with my strategy, depending on what's happening in the markets, okay? Now, the pros and cons of trading currencies, and this is just my personal observation, okay? The advantage of trading Forex is that you could get started with the least amount of capital versus all the other different asset classes. You need money to trade stocks. You need money. You need money to get into the futures market. You need money. But with the Forex, the fact that you can get started for $50 to $150, make it an even playing field for any and everybody. I like the liquidity in the market because you could trade 6 days a week, Sunday through Friday, 23 hours a day. Now, we're not trading 23 hours, but it's available to you. Also, by trading the Forex, you can make money when the markets go up, and you can make money when the markets go down. And I mean, there are strategies that are out there where you can make money when the markets are just moving sideways, okay? Now, the cons of trading just currencies, I'm talking about just the currency pairs, is the pip size, the money that you make per pip, you know, with the currency and the pip being 10 cents per pip. I like to trade another asset class that gives me more money per pip, even at the lowest lot size, okay? Also, with the currency pairs, it take you longer to make up the spread versus what I'm finished to talk about. Also with currency pairs, like I told you, the most money is made in those two time frames. So either you trading first thing in the morning or you're trading in overnight at 2 a.m. Okay, so it's really only two times when the most money is in the systems where you'll make the most money, and it's just those two times. So that's the con of trading foreign currencies. So what I want to do is I want to introduce you to what I trade. You know, I trade currency pairs, and I talked about currency pairs because I wanted you to understand what Forex is. And most people who are trading Forex, they're trading currency pairs. But what I like to do is I like to make the cake. I like to go where all the money at. And where the money at is in indices. It's in trading the indexes. It's in trading the actual market. And so when I make money, I make a lot of money in a short period of time, and all I'm trading is indices. Currency pairs are the last thing that I trade. They're like the icing on the cake, but the cake is indices. And so what you are going to be introduced next week is you're going to be introduced to a trade strategy that's going to teach you how to trade the cake. The cake. The SPX 500, which is the S&P 500. We're going to trade US 30, NAS 100, XAU USD, which is the gold versus the dollar futures, and then you also are going to be able to trade Bitcoin, all from the same platform. Now, why do I prefer the indices? Number one, they do pay you more per lot size. You make way more money. With the SPX 500 at a 0.10, which is the smallest lot, you're going to make $1 per pip and not 10 cents per pip. Okay? Now, there's more volume spikes when you're trading the indices. And so the big money is between 7 a.m. and 9:30 a.m. And when I say this, I'm talking central. 7 a.m. to 9:30 a.m. Big money. 2 p.m. to 3:15 p.m., which is when the markets are about to close. You'll always catch a move. Money. 5 p.m. to 6 p.m., which is when the markets reopen. So when I say 23 hours, that means that the market are going to close at like 4 o'clock, and then it opens again at 5 o'clock. So there's an hour window where the markets rest, consolidation, all of that, okay? So from 5 to 6, when the markets reopen again, you can catch a quick move. 9 p.m. to 10 p.m., you're going to see a move. 1 a.m. to 3 a.m., you're going to see a move. So versus currencies where it's the middle of it's the early in the morning or it's the late at night. You know, you see a lot of people who trade Forex, they always trading in the middle of the night because that's the only time they can really get some money. But with the indexes, you got 5 different times to try to find you some money. So there's no reason why you can't make money when you are trading indices. So the indices is the cake. The currencies is the icing. And so for all of the training, for the most part, we're going to spend the most time teaching you how to trade indices. So again, we are going to be trading the US 30. The US 30 is the Dow Jones Industrial Average. The Dow Jones represent 30 of the world's largest corporations. So, you know, you got Coca-Cola in here, you guys. You got Visa in here. You got Nike in here. You got the gas companies, the Chevrons, the Exxon Mobils. They are in the Dow, all right? And so obviously, when things go wrong with one company, it can drive the movement of the index. So obviously when oil, there was like the oil prices went down to the basement, that was going to bring the Dow down, okay? And so what we're doing is we're able to trade the movement of this entire index that represents 30 company stocks. If you look at the Dow Industrial Average, it's valued at $24,575. $24,575. Now, there are people who can buy the index, you guys, at $24,575. But you get to speculate this index with your little $150. And you get the same power of movement than anybody else. The NAS 100 is the NASDAQ 100 index. This represents all of our tech companies. So the Microsofts, the Apples, the Amazons, the Facebooks, the Cisco systems, they in here. They're in the NASDAQ. And what you'll notice is that, you know, the NASDAQ, if you look at this chart, this is a part of the NASDAQ over the course of pretty much a year. And you see how the NASDAQ was going up, up, up. These the tech stocks, these the Facebooks, these the Amazons. They was moving the price up, up, up. And then what happened? The coronavirus happened. And when the coronavirus happened, it went into free fall. And it went to the lowest points, right? And then what did it do? A V shape started to form. The markets moved right back up. So the people who bought the Microsofts and the Facebooks and the Amazons and the Apples after they fail, you in the money from a stock perspective. That's why when the markets fail, everybody was scrambling trying to buy stock, because the only way they make money is when the stock price go up. So they're trying to buy it low. Now, the beauty of you being able to trade the whole index is you could have made money up here, and you could have shorted the market, and you could have let it free fall and made all the money when it went down to the basement. Rang the register, got your money, and did a buy at the bottom, held it open, which is what them big power traders are doing, and they rode it all the way back up. And so you have the power to make money when it go down and when it go up. So when it comes to NASDAQ, if you want to trade the NS 100, you want to be paying attention to the news, and we're going to talk more about that next week. That's why we watch CNBC. We keep up with what the companies are doing. When companies miss their financials, when their earnings are bad, their sales are bad, their revenues is bad, if they decide to stop paying dividends, all that will affect an index. So we pay attention to CNBC. We watch the financial channels. We pay attention to Yahoo Finance. You can download the app to your phone. We're paying attention because any move in one big company can drag an index. When Apple was having their problems with China, the indexes failed. If Amazon ever have a problem, the indexes is going to fall. And so you can trade NASDAQ. We also have the SPX 500, which is the S&P 500. And it's an index of 500 of the world's largest stocks. So you got pharmaceutical companies in here. You got McDonald's in here. You got banks in here. Tons of companies are in the S&P 500. And if you look at the S&P 500 chart, all the charts pretty much did the same thing. They did a V. But what you notice is that the S&P is not as high as NASDAQ. And that's because NASDAQ got all the internet tech companies. The money is in technology. So if you were trading the NAS 100, all you should have been doing is a bunch of long trades and riding the market up. The S&P been kind of going up and down, sideways, up and down. Okay, so each index does the same, but the overall look of the charts is the same. From the SPX to the Dow to the NASDAQ, they charts look the same, but the bigness in the movements, the volatility depends on what's happening in the indexes, which is driven by these companies. Bitcoin. Now, the great thing about Bitcoin is one of the most highly traded cryptocurrencies. So Bitcoin is a cryptocurrency. It's another form of money. There are a lot of different cryptocurrencies that you could trade. Bitcoin is the most known and the highest traded. And because it's been around long enough, people are getting used to Bitcoin. They're getting used to the idea of Bitcoin becoming the premier form of currency. And so a lot of people are trying to own Bitcoins, but guess what? Bitcoin is over $9,000. So for the average person, you can't afford to buy one Bitcoin, okay? But we do have some people that are in my account with us on our group who can afford a full share of Bitcoin and actually own shares of Bitcoin. Not shares, but a coin of Bitcoin, right? Now, for you, the good news is you can day trade Bitcoin. You can scalp Bitcoin. Bitcoin moves up and down just like all the indices. And so I'm going to teach you how to trade Bitcoin. And so when Bitcoin was high and when the markets fell, guess what? Bitcoin fell too. Now, this was interesting because usually when the stock markets are going down, Bitcoin will go up. And when the markets go on a bull run, Bitcoin will go down. And so a lot of people was using Bitcoin to hedge. And the hedge just means that when the stock market going down, they'll get into Bitcoin and ride it up and make money to offset the losses in their stock portfolios. Okay, so basically what I'm teaching you guys is I'm teaching you how to hedge your investment accounts. Remember, if you're in a 401k, you don't control it. You don't control it. And so with your 401k, you got to deal with the ups and downs of the markets. And so if you learn how to day trade in the Forex markets or any other asset class, when your 401k is taking a hit, you should be making money on the day trading side to offset what you lost in your 401k so that you never lose money. But if you don't learn this skill set, whether or not you're going to have money when you retire is solely going to depend on the markets. Okay. And so the great thing about Bitcoin is that Bitcoin is available 24/7. So Bitcoin never closes. You can trade it 24 hours a day and you can trade it 7 days a week. So again, all the other markets, the Forex, the futures, the stocks, they are open from Sunday to Friday. They are all closed on Saturday. Bitcoin is open on Saturday. So you literally can make money every single day of the week. And so your homework assignment is you need to get your brokerage account set up. And what you're doing is you are getting, you're opening up a demo account. So everyone that was added to this group, you were told to look at the file section in the group. So when you go into the LSC Forex Profits group, you're going to look for the file link. When you click on the file link, you are going to see step-by-step instructions on how to open up your demo account. We are going to be trading our demo as well as our live account through Hugo's Way. It is an international broker that is going to allow us to trade currencies, cryptos, Bitcoin, as well as indices, all in the same broker, okay? And so what you're gonna do is you're gonna set up your demo account, follow the instructions. When you set up your paper account, we're gonna change these amounts. In the document that gives you the step-by-step instructions, it tells you to set your paper account at $1 million. I don't want you to do that this time around. With this group, I want you to set your trade account from 1,000 to 10,000. That's how much paper money I want you to put in, because I really want to see, do you pick up on the strategy? Because the more money that's in your trade account, you tend to trade higher lot sizes. That's going to give you a false sense of reality, because when it's time to trade live account, if you're not putting in $1,000, you're not putting in $10,000, you should not be trading at 1.00 lot sizes. And so I want everybody to set up their paper account. between $1,000 and $10,000. Okay. Once you open up your brokerage, your demo brokerage account, then you're going to download MetaTrader 4 to your computer, and you're going to set it up first. So don't download MetaTrader 4 to your mobile device first. I need you to download to the computer first, set it up on the computer first, then it will sync to the mobile device. Okay. And so that's basically what we're going to be doing. And so, like I said, you're going to be going to Hugo's Way. And like I said, what I love about Hugo's Way, you have leverage. You can leverage up to 5 times the amount of money in your account. As you can see, you can trade all the major currency pairs. You can trade Bitcoin versus the US dollar. There's Litecoin. There's all type of different currencies that you could trade. The indices are here, from the S&P, the NASDAQ, the USD. You can also trade commodities like gold and oil, all from this one account. Okay, and so when you go to MetaTrader, you're going to scroll all the way to the bottom, and you're going to click the link that says demo sign up, and you're just going to go through the process of setting up your demo account. Once you set up your demo account, they're going to give you credentials that's going to be emailed to you. When you look at the documentation, you will see it step by step. Once you set that up, you're going to come back to this site. No, you have to come back to the site. Within the email that they send you is going to be a link to download MetaTrader 4 for Windows to your computer. Now, there's also a download MetaTrader iOS. For some people, this has not been able to work for them. And for some people it is. I do know that it'll work on your iPads, but a lot of people are having trouble trying to use Mac computers. So like I said, the best thing that you can do for yourself is take $200, buy your HP laptop, and make that your trade laptop. All right, you guys. And so that's your homework assignment. And so on next week, we are going to be going over MetaTrader. You're going to know how to maneuver and navigate the system. You're going to learn how to set your charts up. I'm going to give you some indicators that you're going to include into your charts. You're going to get a trade strategy. And that means that by next week, you're going to be able to make your first trade in the markets. Okay, so your homework for tonight is to get your MetaTrader demo account set up on both your computer, your phone, as well as your iPad, if you have it, okay? And then next week, we're going to go over a trade strategy so that you can jump into the markets and grab this money, okay? So that is going to be the end of this Forex class. This class is recorded. I'll probably upload it to the group sometime tonight, and also add it to the files section of the group. So if you are new and you do not have MetaTrader 4 set up, you need to get it set up and have it set up and ready to go for class next week. And so we'll be meeting next Wednesday, same time. And so next week gonna be a little bit way more information, because next week you're gonna have to learn this trade strategy and get your chart set up. And I need you guys to start taking y'all practice trades starting next week. So again, if there's any questions, you can drop them in the group. Someone will answer you. And thank you for hanging out with me tonight. And I will see you guys. Yes, you can set up different accounts even with your MetaTrader. You might have to use a different email account, and you can go in and you can change your dollar amount to practice with. Especially if you know that you're gonna set up your account with let's say you're gonna set up your account for 500, you can make your demo account 500 to see if you pick up the skill set. You know, can you flip 500? You know, because the one thing I'll tell you is if you don't truly understand the trade strategy and you go live, the markets will humble you. You can't randomly just jump in candles and make money. You'll get lucky a couple times, but when you lose, you're going to lose and you're going to blow a whole account. And I don't want anybody donate no money. So I want you to take this serious, take what I'm saying serious, practice and learn this strategy. I'm going to teach you next week, and let's get this money. All right, y'all. Y'all have a good night. Thank y'all for, wait a minute, I got to get a picture. I always forget to get a picture, y'all, even though most of y'all have cut y'all video camera off. Don't be cutting your camera off. Hey, Randy, how are you? How are you? Let me get a picture, y'all. Yes. Forex class in the building. All right, y'all. Again, thank y'all for being here. If you got any questions, drop them in the group, and I will see y'all next week. Talk to you later. Good night.
All right, I have a question.
Yes.
I did a thing on Word, going up and down, buying and selling. I'll give it to Tisha and you email it to you or something. So I need to understand that part.
Oh, buying and selling? Yeah, we can go over that. And yes, you can hit me up in Messenger, or you can email me at cmbleader@gmail.com. That is CMB.
Wait a minute.
Okay.
CMB?
Yeah, CMB leader. All in what, you'll put it all together. cmbleader@gmail.com. And we can, and I can show you, we can go over your understanding of buying and selling. Because especially if you're used to trading stocks, because if you're used to trading stocks, this confuses you because you think you gotta buy in order to sell, and you don't have to do that. So we'll go, me and you can work together and go over that so you'll understand what I'm saying. And matter of fact, I'm still sharing my screen. Am I still sharing my screen? Wait a minute. Let me go right here real quick. This is the easiest way from, so let's say this is the candle that I'm in. Let me find my pointer real quick. So if I'm looking at this chart and I'm looking at this candle right here, this candle is green. Now, I'm not going to jump in this without having all my other strategies into place in this chart, but I want to show you what I mean. But let's say I think that this price is going to go up some more, and I want to go ahead and get in right here. I can go ahead and I can hit the buy button. So when I hit buy, I'm now in the trade. I'm in the trade. Now I'm losing because if you look down at the corner right-hand side, I'm losing. I'm down $2.82. But that's because I wouldn't have took that trade. But that's if I think the price is going to go up, I buy, and I am waiting for this candle to cross over this line. If it don't cross over this line, I'm not in the money. I'm losing money until it crosses over the line. Once it crosses over the line, then I'm going to go from my profit being negative to my profit being positive. That means that's money. And whenever I want to ring the register, I just click this X and it's going to take me out and it's going to give me my money. Okay. So that's what buying means. I think these candles are going to move up. But let's say, I'm going to close this out. Now, let's say I think the price going to go down instead of going up. So if I think this candle is going to go down, which means a longer red candle is going to form, if I think the price going to go down, I want to get in right here. I'm going to go up and I'm just going to hit the sell button. When I hit the sell button, now I'm in the trade. And so what has to happen is this candle has to cross below this line and I need to get into the money. So that means that the price is going to have to go down in order for me to make some money. If it goes the opposite direction, then I'm losing money. Okay, and that's pretty much what's happening, because as you can see, it's down $7. It's doing the opposite direction. But that's all buy and sell is. You hit buy if you think the price gonna go up, and you hit sell if you think the price gonna go down. So whatever you decide to do, When you want to get out the trade and take your money, you just close. When I hit close, I'm out the trade. So I'm not in no trade right now. So again, if I think the price gonna go up, I hit buy. And then get out my trade based on making money. If I think the price gonna go down, then I'm gonna hit sell, and then I'm gonna get out my trade, okay? Now, again, because we have the ability to leverage our accounts, I can hit this sell button 5 times if everything is going my way. So if everything going my way, you guys, I can hit the sell time 5 times, right? I could do that. So I can hit sell once. I'm in a position once. And let's say I think it's at some point in time, it's gonna go down again. I could get another position. I can even hedge. I can even hedge and I can do a buy. I can do a buy and sell at the exact same time. And if I don't know where the price gonna go, I could do a buy and sell at the exact same time. And if it start going to a buy, I can always close out my sale, but I can also hedge my account. So it's power in this system. But every time you hit the buy or sell button, it puts you into a separate position. So again, you don't have to buy to sell, and you don't have to sell to buy. It's none of that. You're just taking a position. And so me and you will talk more so that you'll understand what I'm saying. If I think the price going up, I'm gonna hit buy. If I think the price is about to go down, I'm gonna hit sell. And as you can see, this is just rocking back and forth, back and forth, back and forth. I don't know what this is gonna do because I ain't even got my charts set up, but that's in a nutshell how you—
I had my support and resistance set up. Okay, and then the 50 goes above and the 200 goes above, and that's what I was trying to figure out, buy or sell, and then it goes down below. That's what I was asking about. I have a little chart that I'll send to you, and it's partially filled out. Then I understand better with support and resistance.
Makes sense. Once we talk about it, and then next week we will talk about it again. So let's say, for example, you see how the 50 it crossed under the 200. That's letting you know that the price is falling down more. So when this happened, it was right here on this candle. So you actually could hit short and you could have made the money from here to here. Now, once you get out of trade, you gotta wait for another setup before you get in again. As long as the candle stay under the 50 and the 200, it's going to short again. So this might move up, but when it get close to this 50, it's probably going to fall back down again, and I'll get another opportunity to hit short. So really, you catching it when it cross. If you miss the cross, you got to wait for another setup. And so we'll go over that again. Me and you could go over it, and then next week I'm gonna go into more details so that it can make more sense to you. Okay, y'all. So Randy, reach out to me so that I can talk to you. And then, like I said, next week, we'll go over this trade strategy so you'll understand what Randy talking about, because some of y'all don't even know what Randy talking about right now. And so we'll go over that tomorrow, not tomorrow, next week. And then next week, I'm also going to give you a checklist. That way, when you see certain criteria happen, you'll know to get in and when to get out. All right, you guys.
Bye. Can we talk to the person who sent
Thank you.
You can do what?
Thank you.
Can we speak to the person who introduced us to the program?
Yeah.
About how to get in by using the demo?
Yeah, absolutely.
Okay. All right.
And like I said, if you got any questions, you can drop them in the group. Somebody, if me or some of my other traders, will be able to answer your questions.
Okay, Mom. Have a good night. Thank you so much.
Good night, y'all.
Good night.